All right. We're ready to rock and roll. How is everybody doing this morning? It's nice to see you all here. Bright and early, first thing in the morning. So let's come in here, and the first thing I want to do, let's turn on this little thing just to show people what's going on here. And then I want to come in here, and let's put me over here so you can see. Well, yeah, I'm good where I'm at. All right. So what I want to do today is I want to come in, and I want to talk to you a little bit about the easiest and simplest trading strategy in the whole world. All right. Easiest, simplest trading strategy in the whole world. And then we're going to take it and we're going to do the exact same thing with options. So we need to understand something, first of all. So when we trade, we need to have enough money to buy the item that it is that we're trading. I know that's kind of a new concept for many people, but that is kind of the concept that we're going to be working with here today. All right. So what I want to do now is I want to come in and I want to talk to you about orders and order tools. And we need to understand order tools. So most people, when they trade, now I'm going to come in here and we're going to come down to, let's come down to a 1 minute chart. We're going to come right down here to a very tiny chart, just so that we can, let's do Tesla. We're going to come down here to a 1 minute chart on Tesla, and we're going to talk about order types. All right. So that you can understand them a little bit better. So this is a 1 minute chart. Now, it doesn't matter whether you do this on a 1 minute chart or whether you do this on a daily chart. Doesn't matter. The rules are the same. All right. It's just easier here so that we can see them down here where the market's currently moving and trading. It's not shaking, and there it's moving a little bit. Pretty quiet market. Pretty quiet morning today. So we're going to come over to our trading tab, and I'm going to talk about different types of orders. So we're going to start off with different types of orders, and then we're going to talk about the very simplest, easiest trading strategy in the whole world. And then we're going to take that strategy out of the 1 minute chart. We're going to go do it on the daily chart. And then from the daily chart, we're going to do it with options. And we're just going to do the exact same strategy. We're just going to do it with options. All right. So I'm going to show you the exact strategy. But first, we have to understand order types. Now, many of you already know and understand these order types. Many of you don't. I think it's very important that you understand the order types. So the first order type that we're going to run into here is we're going to come in and we're going to use the market order. So a market order is very simple, very easy. If you want to buy the shares and you think the market's going to go up, you just hit buy market. And there you go, you bought one share. Now that's one share. And one share of stock is not very much. Now, if we're over in the futures market, one share is a lot. All right. But in the stock market, one share is tiny. It's pennies. All right. So you can see the market's moving 9 cents. Okay. And so one share, you can trade with one share if you have a tiny account, just to get used to the concept, right? To understand what's going on, to practice, just do very small amounts. But we're going to start with, so we're going to exit this one. So we're going to say exit chart. The market is gone. Okay, so we're out of the market. Very easy. All right. So if you buy market, you get in as fast as the market can get you into the order, and then you can either hit sell market to get you out, or you can just hit exit chart to get you out. And that's it. Now, there's an easier way to do this. All right. There's an easier way, because you don't know if the market's going to, I don't know if I want to buy it right there. It might go down, right? I don't know. It might go down. But so what we can do is we can use what we have called here a limit order. All right. So a limit order, if we take a limit order, and this one we can specify a price. We can say, well, you know what? The market's way up there. It's been way down here. So I can come in here with the limit order and I can say, hey, look, if the market comes down to this price level right here, that's where I'm going to buy my share. All right. So you get to specify a price. You get to say, hey, I'm not going to buy it unless it comes down there. Remember the old adage, buy low, sell high? Somebody told us that once, right? So if you establish what is low, what is low? Well, on this market, I don't know what low is. I might buy one right here. And if I wanted to, I could say, well, if it goes down a little more, I'll buy another one right here, or I might buy another one right here. All right. So that would get you 3 shares. So you could do that. And that would, as the market comes down, you'd buy one, you'd buy one, you'd buy one. If it keeps going down, you're going to lose money, right? And then it'll eventually, the idea or the concept here is that we think the market will eventually turn and go back up, and we'll have our 3 shares. Now, if we got 3, well, you're going to have an average of those 3 prices, right? So if we buy one here, we buy one here, and we buy one here, we're going to end up with our order price right here in the center, because this one's going to jump up to that one. This is going to jump down to this one, and we'll have an average price of those 3. So you're going to take the price divided by 3, and that's what your price will be. So that's will be your average price. You bought one way up here, you bought one way down here, you bought one in the middle. It's going to go to the average. Okay, so that's a limit order. That's how limit orders work. So now this is the easiest strategy in the whole world to get into the market, and you're going to probably get a much better price than if you just bought it right now. What's the downside to this? What's the downside to this? The downside is, well, the market could take off and go right now without you, right? Could leave you in the dust. And you're like, oh, well, I didn't get any money. Okay. That's the downside to doing this. All right. That's why we're going to use options, because I'm going to show you a little trick. You can do this exact same thing with options, but still make money. They let you still make money if you do this and don't make any money. If the orders don't get filled, you still make money. Isn't that cool? All right. So that's why I want to do it with options. I want to show you this little neat trick that you can do with options. Okay. So this is the strategy. This is the simplest strategy in the world. You just come in here, you put your limit orders in to buy. Now, you can also put a stop order in. We all know what stop orders are. We come in here with a stop order. You drop that down here. Well, it's not going to let me do it right now. It'd let me do it in the futures market, but it's not going to let me do it in the stock market because these orders have not been filled yet. If these orders get filled, then I can put my stop order in for quantity 3, and it would stop me out if the market just kept going down, and I would lose from the average of the 3 to where my stop order is. That would be my loss, right? Because I stop out. So I don't want to lose any more than that. Maybe the market's going to just keep going down forever, and I don't want to deal with that. So I can get out, and that's what a stop order does. All right. So let's use a stop order. Let's come in here. We'll exit chart. We'll just get rid of all these. Now, those don't cost me anything to put them on. There's no commission because, well, in the stock market, there's no commission anyway. But if you were in a market that did have commissions, those orders didn't get filled. Therefore, you don't have to pay a commission. All right. So we're going to come in and delete all of our tools. Now we're going to come in, and let's say we're going to go in with our 1 share and we're going to go buy a market. Okay. Oh, we're in the market. Great. Now we can use our stop order. We can come in here and say stop order. If it comes down and touches this blue line, or if it comes down in here, I'm just going to get out. All right. So I don't want to get in. I don't want to take any bigger loss because I'm afraid this market might just turn around and keep falling forever. So if it just loses that much money, I'm going to get out. That's what a stop order is for. All right. So that gets us out when we're trying to make money with the market going up. So this gets us out. So we're going to set exit chart. Now there's another way. You can use an open stop order. And of course, you can use an open limit order too, like that one. But we can use an open stop order. We can come in here and we can put a stop order above the market. And notice it's green now. We drop it above the market and say, well, if it crosses above that 200 period moving average, which is that yellow line right there, I want to get in and buy the market. So you can put an order there to get in, and it'll buy the market as the market goes through. All right. So if it goes up through there, that's where you're going to catch it. If it turns and falls, well, you're not going to get in. You're not going to lose money. Why? Because you didn't get in, because it didn't hit your green line. All right. If it hits the green line, well, then it's going to get you in. But the idea is if it hits the green line, we're going to anticipate it continuing higher. So you can put a stop order in there, and that works just fine, just like that. All right. So the limit order and the stop order are kind of the same, but they are on different sides of the market. So a stop order, a buy stop is green. It's above the market. If you put a limit order above like this, you'll notice that it's above the current market price. Well, it's not going to let me do it because it's not filled. But you can see that it would be red if we drop that in there. So you got a sell limit above the market is red. That would be a sell. The market have to go up and touch it and turn around and fall to make money, right? If you get you in. And then the green one is the stop order. So it would have to go through the green line, pick up your order, and then keep going because it's a buy. That's why it's green. All right. Green buy, red sell. So it would be sell above the market. So that would be the two sides of the market. So we could do the same thing. Exit chart. We could put a stop down here. You'll notice the stop is red on the bottom side, and they're going to let you do it unless there's an order filled. But you could put a limit order down here and notice the limit order is green because you're going to buy below the market. All right. So you're going to set your limits where I'm willing to buy the market. Okay. So that's how that works. Very simple, very easy. So one of the most popular strategies is to come in here. Let's say you just want to get in with 100 shares. All right. So we're going to buy 100 shares, and we're going to put a stop order down here. Oh, I'm going to get out if I'm wrong, and I'm going to take a profit with a limit if I'm right. And it's not going to let me do it because I get the stopping. The stock market has lots of crazy rules that you don't have over in the futures market. Let's see if it'll let us tie those together. We're going to add an OCO. So we have to tie them together and put them on the same ticket. Now it'll let you do that. All right. So now we have a limit order up there, which is going to take the profits, and we have a stop order down here, which is going to get you out with your losses. All right. So see how that works? So with 100 shares, you can come in here and you can have a limit order up there, and that's your profit taking. So it's going to make all the money from where you get into the market to where you get out of the market. That'd be $331. And if it turned and dropped the stop order, you would stop out and lose $202. But hopefully the idea is that, well, it's going to keep you from losing more, right? If it keeps going down. All right, so that is the simplest and easiest trading strategy in the whole world. Let's go ahead and we'll exit out of here. And so all you have to do is you can come in here with your limit order and you can say, well, I think I want to buy it when it's down here. But I'm not going to buy it unless it's down there, 100 shares. I'm going to get a really good price on it. I think if the market comes down to here, I would want to be a buyer because I think at that point it would go back up because that's what it did last time. All right, whatever your justification is, you're going to put a limit order down here. And then you're going to put, once you get into the market down here, you're going to put your, you're in the market, you'll have 100 shares. It's going to give you 100 shares from this point. So then you're going to use your limit order again on this side to take your profits. All right, now, again, it's not going to let me do it because this order's not filled yet. But if this fills, then I can put a limit order up there to take my profits up on top. So again, we'll do it just to example. We're just going to come in here, delete all of our drawing tools. We're going to go in with 100 shares. And we're going to buy the market. Now we have 100 shares. We're going to take our limit order and we're going to put it above the market and say, if I make that much money, that's when I'm going to get out. So that's my profit zone. All right. Now I'm going to go from this level to this level. That would be $497. So if the market goes from where I get in with my 100 shares up to that red line is a limit order, which is going to take me out of the market, right? That's going to take me out of the market and give me $497. Now, what's the disadvantage of this? Disadvantage is, what if the market keeps going higher? What if the market just keeps, come on, stop doing that to me. What if the market just keeps going higher? What if it comes in here and it goes like this? And it goes, woo, way up there. Well, you got out of your $100. You don't get any money above the red line. All right. You don't get any money above the red line because you're not in the market. You got out. If you want to make money above the red line, get back in. It's that simple. Everyone's like, oh, I don't want to put a limit order out there. It'll cut my winner short. Well, get back in then. You can get back in. Everybody forgets that they can get back in. But that would take your profits at $500. It would take profits along the way, right? But that's the disadvantage of putting a limit order out there, is that you're going to take your profits, all right? You're going to get out of the market. Because what happens if it comes up and does this and you didn't get out? Well, then you lose all your money back to wherever you put your stop order, right? So there's advantages to saying, well, I'm going to limit my profits to $497. I'm going to take my profits at $500. I'm happy with that. I can live on that. $500 a day keeps the doctor away, right? We're happy with $500 a day. I could do that. So I'm happy at 500. But you could have made 1,000, Lan. It would have gone higher. Well, I didn't know that, and I don't care. I only want the 500. I'm happy with 500. All right. So this is the easiest, simplest trading strategy in the whole world. All right, so now we're going to take this same concept. That's a day trading strategy. All right, so that's how day trading works. So we're going to exit out of here. And we're going to take the same concept. We're going to go over to the daily chart. All right, so here's a daily chart. Same concept. This is just going to take longer to do it. All right, so we're going to come in here. And I'm going to come in. And if we're looking at Tesla, and this is on a daily chart, we're going to say, oh, wow, I would like to own some Tesla. All right. I would love some Tesla, but that Tesla is really high right now. If I draw a trend line across these peaks up here, you can see it's way up there. This is the highest it's been in a long, long, long time. It hasn't been up here. Oh, last time it was that high, it turned and fell a long ways. All right. When was the last time Tesla was that high? Been a long, long time. Okay. Has it ever been that high? Well, not in the recent. It doesn't look like it's ever been this high. This is the highest Tesla's ever been. All right. New high for Tesla. So that's a Tesla. And last time it got up that high, went up that high. It did. It went up that high, but then it flushed really hard. So you're like, well, I don't want to really buy Tesla up there. It's kind of scary. So I would like to buy Tesla down here somewhere. So you're going to do the exact same thing that we did on the daily chart as we just did on the 1 minute chart. So you're going to come in here, go over to your trading tab. You're going to put 100 shares in there. And you can say, I'm going to put a limit order right down here. If I could buy 100 shares right there of Tesla, I'd be really happy. You know, if you look back here, you say, well, you might want to wait for it to come all the way down here. Well, it might not come all the way down there. Tesla's got some good news, right? Fundamentally, Tesla is a really strong company. That's why it's breaking new highs. But I don't like to buy high and sell higher. That's a hard way to make money. So I want to buy low, sell high. Well, what's low? Well, right here's a 200 period moving average. And if we drew a Fibonacci ruler, which is what this is for, that's why Fibonacci measures from the high to the low, it tells you where halfway is, right? So halfway back is right here, 50% retracement. So that might be a good place. You say, well, if Tesla came down to there, I'd really be happy to buy some. Or you might come in here and you might put a limit order here, and you might put another limit order here, and you might put another limit order here, just like we did before over on the 1 minute chart, right? So you might come in here and you might do the same strategy on Tesla on a daily chart for your long-term investments that we did on the 1 minute chart for our day trade. It's the exact same concept. There's nothing different. We don't do anything different on a 1 minute chart than we do on a daily chart when we day trade versus when we position trade. The only difference is that this strategy is going to take you years to pay off, and the one on the daily chart is going to take you a day to pay off, right? Or to lose money, because it doesn't only pay off. Sometimes you lose money. So you're like, well, I'll hang on to it. I won't get rid of it. Well, then you're not a day trader. You're a bag holder, right? So, and then the market could just keep coming down, 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 down. And you on your day trade said, well, I'm just going to hold it till it goes back up. Well, you might hold it for 5 years before it turns around and goes back up. That's why you don't do that on a day trade, because the day trade is a myopically viewing that one little tick right there. That's the one. Come on, stop doing that to me. Why are you jumping all over the place? So that you're just looking at this one little tick right here. So then you can look on the daily chart, you see there's a lot of downside potential for this stock. All right. So but we'd be really happy to buy some Tesla down here, right? Wouldn't you? I mean, you'd love some Tesla down here. Now you might not want 100 shares, depends on the size of your account, but you might want 100 here. If you could afford it, that would be 32,000, 35,000, 39,000, right? So $39,000, we could afford that. We got 124. Another 33, be 60. We could afford that. And then another 30, 89. We could afford all three of these. And we would be almost fully invested into Tesla at that point if all three of those got filled. And we'd be happy about that, right? We'd be, oh, yeah, all right. I'm rocking and rolling, man. I got me some Tesla down at some good prices. All right. Now, you might also, once we get those orders filled, we might come in here and we might come in and we might put a limit order on the upside, right, up here to sell it, right? Same thing. I can't do it because I'm not in the market. But if these got filled, then we could go ahead and we could put our limit orders up here and they'd be red, which would be selling and taking our profits. And it would be taking our profits from where? From wherever we got in. So we probably wouldn't put it way up there. We might put it right back up here. We might come in here and say, if it drops all the way down here and fills this order and then turns and goes back up, I might want my profits when it tops out and comes up and tests this high again. And I could do that, right? You're saying, well, Len, what if it goes higher? Well, I'm going to just take my profits here. I can always get back in. But if I put my profit taker right up here, then I'm going to take my profits when it tests these previous highs. And that's a good strategy. That's the simplest, easiest strategy in the whole world. All you're doing is using limit orders instead of stop orders and market orders to get in where you want to get in and get out where you want to get out, right? Buy low, sell high. That's how we make money in these markets. Buy low, sell high. Now, if you're not going to sell high, you're going to just hang on to these markets forever. Well, then you don't want to put your limit order in there. And that's okay too. Nothing wrong with that. It just depends on what your strategy is. The way you make money. How do you make money? Somebody asked me this question the other day. Hold on, let me get a drink of water. Give me 1 second. Somebody asked me the other day, they said, Lan, if you just go and buy stocks like most people do, they just buy stocks and they hold on to them for the rest of their life. What good is that? What good is that? How do they, you can't live off of it if you don't sell it. Eventually you got to sell your shares out, right? Well, technically, that's kind of the general rule. You buy low, sell high. And so you buy one when you're 30 years old. When you get 65 years old, you're going to start selling your shares off, right? And they're going to be a lot of money and you're going to eventually run out of shares to sell, right? So that's the big fear, is everybody's afraid they're going to run out of money. Well, you don't have to sell your shares. There's ways you can keep your shares. Once you buy them, you never sell them, right? There's a lot of those types of people out there, but there's ways that you can make money off of your shares that you don't sell using options. Okay. And that's a strategy that we can talk about here. We're going to get to that in just a second. I'm going to show you how that works. But the whole idea is that you generally have to offer to sell your shares, or the other way that most people do it is they borrow against them. All right. So let's say that the markets are going up and they're averaging for you over that 20-year period of time. You're averaging 5 to 10% annualized return on your shares. All right, maybe you're in the S&P 500 and you're making about a 10% average over the years, over that time frame. That's a lot of money. It's pretty good. By the time you get, the S&P 500 at a 10% growth over 20 years, you might have doubled, tripled your money, something like that, with a little bit of compounding. And so you got a good little nest egg in there. But you don't want to sell it because it's not like you're rich, rich, rich beyond your wildest dreams and you can go out and live high on the hog. You're a little bit worried about running out of money before you die. Yeah, maybe you're going to live to 110 years old. Who knows, right? So you don't want to run out of money. So what you do is you borrow against it, right? You have to borrow against it. And they have margin loans and you can borrow against it, just like you can with your house. So if you want to buy something, you got a lot of equity in your house, you can go to the bank and you can say, I want to get a home equity line of credit. And you can borrow against your house and then you can go buy things that you want. Now, if you die before you pay that back, well, they sell the house and then it pays off the loan, right? That's how it works. And then your kids get to keep whatever's left after you've spent, half the equity in your house on your four-wheeler and your mobile home. Well, that's okay with you. You don't care. You die. And it's okay with them too. They don't care because then they sell the house because they don't need it. Or maybe they do, but let's say they don't need it. So they sell the house, pay off the loan then they get the money that's left over on the house. And then they get the four-wheeler and the mobile home. All right. And they can sell those too. And then they can go buy another house, whatever, but that's how you do it. You borrow against the equity of whatever it is that you own. So buying assets allows you to borrow against it. So you have to pay interest against it. And that's part of the game. You say, well, I don't want to pay interest. Well, it's the only way you can get to your equity nowadays. You have to borrow against it. And you can do it with a home equity loan on your house. Or if you have stocks, you can borrow against your stocks with a margin account. So you go into your brokerage and you just borrow the money. And most people will borrow the money and then reinvest that borrowed money back into the stock market. You can do that. It's a little dangerous. I mean, you're borrowing money. You're borrowing your own money to reinvest it. And that's okay. A lot of people do it. All right. And that's what it was designed for. But you can also borrow against it. You can borrow against that money and you can go buy things with it too. So that's how you can live off of your stocks without ever actually having to sell them. And then because they're growing on an average, let's say 10% annualized return, and your interest rate is, let's say 4 or 5% return, well, your growth will pay for the interest. And you have some additional growth in there as well. So that's kind of the concept. So just kind of rattle that around in your head. If you haven't thought about that before, that's how it works. And that's how you can live off of your stocks without actually having to sell them. All right. You just borrow against them and let the future growth pay the payments. Just hope they have future growth. That's the downside. Well, Lan, what if the market doesn't have any future growth and it keeps going down? Well, you're going to have to start selling off shares to pay your mortgage, all right, to pay your stock. If it just keeps tumbling down and you borrowed against it, well, you're going to eventually have to sell some shares to pay those mortgage payments or those loan payments. All right, that's how it works. But that's called an S block. All right, so you're borrowing against your stocks instead of a home equity, a HELOC. Right? HELOC or an S block. So that's how you do it. But we're going to do it a little bit different way. We're going to do it with options. All right. So let's get into options now. So this same concept, we're going to do the exact same thing that we just did with limit orders. We're going to do it with options. Okay. So we're going to come in here. We're going to exit the chart and we're going to get rid of all these things. We're actually not going to get rid of this. We're going to get rid of this white line right here. If we can get rid of it, come on, delete the arrow. Okay, so we're still going to keep our Fibonacci ruler in here. So we know that if on this Tesla, we would love to own some Tesla, but I don't want to buy it up here. I wish I could have bought Tesla here, or man, I'd have loved some Tesla here. Oh, I'd really love some Tesla down here, 61.8. We know that this is the Fibonacci sweet spot. Markets have a tendency through the delta cone of probability to come back to this region right here, right? So if it's up there, we have the ABC pattern probability, all right? Of course, you got probabilities of ABCs going up too. So if market come down and it could come up and we could do another ABC like this. Come down a little bit and then it could go up some more, right? We know that. We know that there's upside potential on Tesla. Plus Tesla fundamentally, we know, making money. You want to do a little fundamental work on Tesla? We got a couple minutes. Let's go ahead and real quickly, I've got it pulled up here already. We can come in here and we can go over to our right here. And we're going to go to TSLA and we're going to look at Tesla. And you can see from the fundamental side of things, Tesla's making money. Look at their sales. That's what we really want to know. What are they making money? They are. They're selling. They didn't do as they did. 2024 they did 97. 2023 they did 96. We all know Elon got a little bit political and lost some of his clients. So 97.69, and sales this year is 95.63. So he's not quite yet doing as well as 2024, but 2020 we haven't got the final numbers for 2025 yet. And I think 25, I think he'll beat 97. He's at 95 right now, 6.7. He only has to do 2 billion to beat 97. I think he'll do it. All right. I think he'll do it. Maybe not. Maybe he'll be just right there at the exact same numbers, right there at 95. But I think he'll beat 97. He's got a couple to go. All right. And so that's kind of where we're at. His shares outstanding. He's keeping them even. That's good. He's not buying them back. I don't want him buying them back. Don't buy your damn shares back, Elon. I don't want you buying your shares back. All right. Now his earnings per share are going down a little bit because he's not making the hand over fist money that he was, but he's going to. You wait and see. He's doing his robo-taxi thing, and that thing is going to go to the moon. And he's also doing his robots, and that thing's going to go to the moon. So he's got two big product lines coming up in Tesla. So this is just cars. These sales in billions this is just cars. And he's got two more big lines coming up. He's got Tesla's going to do robo-taxi, and they're also going to do robots. And so he thinks robots are going to make cars look like baby numbers. Okay, so there's big speculation for the future growth of Tesla, and that's why everybody wants Tesla. So we're going to come back over here, and we're going to say, well, I want to own some Tesla down here. So we could do it with limit orders. We come in here and we put a limit order in here. I'm going to buy some Tesla right here. I'm going to buy another 100 shares of Tesla right here. I can buy another 100 shares of Tesla right here. Now, why do I use 100 shares? Maybe I only want 25 of each one. Depends on the size of your account. Depends on how much Tesla you want. But the reason we use 100 shares in these examples is because an option, we're going to use options, and an option represents 100 shares. Every option represents 100 shares. Now, there's a delta scale, and for those of you who know a little bit about delta, know that the market makes, each option makes the amount of money, makes or loses the same amount of money as the delta. So what we call an at-the-money option. So we're going to come over here, and I'm not going to go great into the options other than to show you the strategy. I'm going to assume you know a little bit about options. You've probably taken my options class before down at the university at St. George, where I teach those at the university. So I teach an options class. And so you probably have a little bit of options understanding, and I'm going to assume that you have a little options understanding. This class is not going to teach you the basics of options. This class is going to teach you an option strategy. And what we're going to do is we're going to teach you this exact same strategy that you do with limit orders, only we're going to do it with options. I'm going to show you why you want to do it with options. But one option does represent 100 shares. And if you remember, the delta tells you how much money you're going to make or lose based on the delta of that option. So an at-the-money option is going to make or lose 51 delta. So that means 51, in this case, 51 shares equal to 51 shares. All right. It's not going to, even though it represents 100 shares, the movement of the market the market will move $1, right? This one will only go 51 cents. The option will only go 51 cents. So it will lose 51 cents on the downside, the option will, at the money, or it will make 51 cents for every dollar that the underlying stock moves. Okay, so it's half right now. And then that's what your delta is down here. So if we go further out of the money, it's going to make or lose down here. You can see this one's going to make 35 cents. So if you can use options to hedge your position. So let's say you have 35 shares. Well, you would use this option right here, that has a delta of 35 to hedge your 35 shares. That way it would make the same amount. It would be a protective option that would make or lose the same amount of money as your underlying stock. So that's how that works. And then you have convexity, which is what moves those deltas up and down the scale. So the delta up here is 72 and the delta down here is 30. Well, that means that you have a convexity scale that's moving that up and down as market prices move through price and time. Now, that's a little bit beyond the scope of what I wanted to teach you today, but I just wanted to make you aware of the delta, and that's why we're using that, okay? So that's called the delta cone of probability, and that's what these numbers here are. This is the probability of being in the money, probability of being out of the money. Those are based on delta. That's why we call it the delta cone of probability. Is based on delta, okay? So you can see that a probability of being in the money of a at the money option is 51%, which makes sense, right? It's right at the money. You have a 50-50 chance that thing's going to be in the money, the market's going to go up from there, or the market's going to go down from there. You don't know. It's a 50-50 chance. So that's why it's there. So as you go further down the scale, well, you have a higher likelihood the market's going to either be in the money or out of the money, or farther out of the scale, it's going to be in the money or out of the money, right? So that's why you have these delta scales, and that's how you get these probabilities. So you're just playing the probabilities, just like you would if you went, don't say it, Lan, don't say it. Just like you went to Vegas, all right? You want to put the odds in your favor, okay? You want to put the odds in your favor. This is more like a carnival game than it is gambling, all right? There's a little bit of strategy to it. It's not just rolling the dice and hoping that it lands on double sixes, right? There's a little bit of strategy to this, so it's not gambling. It's a carnival game. Carnival game. So we're going to play the carnival game. So what we're going to do is we're going to replace these limit orders with options, and we're going to do put options. And the reason we're going to use put options is because put options are designed so that if I clear all these out, we're going to hit these, cancel these orders, and oh, that's on the option. We're going to come over here to trade. So we're going to exit out, exit chart. So we're going to get rid of the limit orders, and we're going to replace them with options, put options. So what we're going to do is if you want to buy a stock, you sell a put option. I know. I'm not going to go into it in great detail why that's how it works. I'm just going to let you know that that's how it does it. And we're going to come down here. We're going to say a 52-day option. So I want to buy Tesla within the next 52 days, and I'm going to go down the delta scale until my probability is really low because I want to buy my shares right down here. So all I do is I sell an option at a delta scale or at a strike price down in this region here, because that's where I want to buy my option. So I'm going to come down and I'm going to put it right at the money. It's really easy to do it in track and trade. Just right click, say buy my order. Actually, I want to sell. We're going to sell an option. You notice we're just looking at the puts. So we're going to come down here and we're going to drag it because I can drag it right to where I want it. Right there. I want to buy 100 shares of Tesla at that level. And if I can get those shares at that level, 100 shares, I'm going to be happy as a duck in water, right? I'm going to be so happy if I could get 100 shares of Tesla right there, just like my limit order. It's exactly the same thing as a limit order. That's what selling a put does. It's called a cash secured put. What cash are you securing it with? Well, you're securing it with the cash that you're going to use to buy the 100 shares. Because that's what you're telling the market. I want to buy 100 shares right here. Now, remember, if you put a limit order in there, you have to have the cash to buy it anyway. So it's a cash secured limit, right? You have to have 100. If you're going to buy 100 shares, you have to have the money to buy 100 shares, or they won't let you put the order on. You can't put the order on if you only have $50 in there in your account for 100 shares. They're going to say, you don't have enough money. Well, that's the same thing here. You got to have the money to buy the 100 shares. That's why it's called a cash secured put. And you're going to sell one because you're going to buy the 100 shares. And so if the market comes down, now here's the carnival game side of this. Let's get rid of all the drawings so it's easy to see. Delete all the drawings. So all we're going to do is we're going to sell a cash secured put. And the carnival game is that to get that cash secured put, the market has to hit that purple line underneath the red line. Well, Lan, what if it doesn't do that? What if it doesn't come down? What if it comes down this far and then turns and hits the purple line up there? Do I not get my 100 shares? Nope. Just like the limit order. You don't get your 100 shares. All right. And this is limited to time. You only have so much time to get the market to come down there to give you your 100 shares. So you want your 100 shares. And that's why you put that order in there. Because if you didn't want your 100 shares, you wouldn't put that order in there. That's what that order is. Now they give you, because it's a carnival game, they give you a consolation prize for not getting your order filled. You get a rubber frog instead of a big panda. All right. Oh, Lan didn't get his big panda. He didn't get his 100 shares of Tesla like he wanted. So we feel bad for Lan. So we're going to give him a rubber frog. Well, that rubber frog for that order is $760. Not such a bad rubber frog, right? Okay, that's the carnival game. So if you put that order in there and this market doesn't come down and hit the purple line underneath the red line, well, you don't get your share, so they give you the consolation prize of $760. And you're like, whoa, really? I get a consolation prize of $760 if I don't get my shares? Yeah, that's not a bad deal, right? That's pretty cool. No shit. No shit. That's pretty cool. Yeah, those consolation prizes are not so bad. Yeah, I could live off rubber frogs, right? I don't need. What if I never got a panda? Never did get my 100 shares. Well, that would be okay with me. I'll just live off rubber frogs. Okay, just live off of rubber frogs then, because that's what that is. That's the way that works. Okay, so you're going to receive $753 return on risk. That's an 11% annual. That's an 11, not annualized. That's an 11% return in 52 days. Here, let's do a little math. You got to get your calculator. Look, I bought a real calculator. So we're going to do a little math. See this little calculator here? This is old school. I can't see it. Oh, there you go. That's my old school calculator. All right, so let's do a little math. So we're going to come in here and we're going to say, how many 52 days are there in a year? So we're going to take 365. We're going to divide it by 52 equals, that's 7. So there are 7 52s in a year. So we're going to take that return on risk of 11.53. So we're going to times that by 11.53 equals, that's an 80% annualized return just playing rubber frogs. We didn't even get our shares. We just got the consolation prize of $760 and an annualized return. That's 80%. Well, that's a pretty cool strategy, Lan. Yeah, I think so. But you own your shares at that level. But what's the downside? Well, what if the market comes way down here and touches this down here? Well, you own your shares at this level. You are happy to have your shares at that level. So if the market does actually come all the way down here, well, you own your shares. You own 100 shares at that price. You're going to lose money. But you were going to hold on to those shares anyway for the rest of your life. So eventually they might come back up, right? And then you'll make money. But you don't care about the drawdown because you're going to own them anyway for the rest of your life. You're not going to do this strategy and buy 100 shares on a stock that you don't want to own for the rest of your life anyway. So what does it matter? Well, Lan, I got a better idea. I'm going to pull this order down farther into the delta cone a little bit farther. All right, I'm going to draw my Fibonacci ruler in there. And I'm going to come down here and I'm going to say, what if I put this here? And instead of buying it way up there at the 38.2, I put this down here at 61.8. Well, you can do that. And then your opportunity of getting filled is very much lower, right? We're going to delete all our darning tools. So right there, you're saying, well, I want to buy my shares down there. How much will they give me? What's my rubber frog? Well, your rubber frog on that one is $229. Woo! So you mean to tell me that the market would have to come all the way down here and touch the purple line underneath there for me to get my shares? Yeah, which you want anyway. And you'd be happy. Oh, you'd be happy buying Tesla shares under the 200 period moving average. You'd dance your way to the grocery store with that one. You'd be really happy to get 200 shares under the 100 shares under the 200 period moving average of Tesla. And if you did, you get your 100 shares. But you know what? You know what's really cool? You're going to get your big panda because they're going to give you your 100 shares. You got your 100 shares right there where you wanted them, which is an amazing price for Tesla shares, right? You're really happy that you got those shares at that price. They're going to give you the rubber frog anyway. You still get the $229. You're kidding me. They give me my shares at that price, my 100 shares at that price, and they give me my rubber frog of $229. Yeah. But if the market doesn't ever come down, if it hits that purple line above the red line, anywhere up here, anywhere above the red line, 1 penny above it, you don't get your shares. All they give you is the rubber frog, the $229. Well, what's the odds that the market's going to come down there, Lan? Well, you can tell it's pretty low. I mean, it's probably not going to come all the way down there, but it might. What's the odds of that? Well, you can look at it on the little delta scale. You come all the way down here and find your order. There it is. It's in the list. Probability of being in the money, 4%. You got a 95% chance that market is not going to go and touch the purple line under the red line. That's what the delta cone of probability, the mathematics of the market are telling you. 95% chance that all you're going to get is your rubber frog. Well, I'm happy with the rubber frog. What if I really didn't want the shares? What if I just wanted the rubber frog, Lynn? Do that then. I don't care. It's up to you. I just want the $228. I don't want the shares. Well, the odds of you getting the shares is pretty low. It's 4% chance you're going to get the shares. That's all that is. That's the strategy. That's the coolest, neatest strategy, easiest, best strategy in the whole world. Why? Because once that market comes down there, they're going to give you the $229 regardless, either way. As long as the market hits that purple line, they're going to give you the $229. And then they're going to give you the shares if it touches the purple line underneath the line, underneath the red line. All right, that's the rule. And then once you own the shares at that level, let's pretend. All right, the next side of this is we're going to pretend like we got that order filled. Right, cancel. We're going to cancel that, but we're going to pretend like we got an order filled. So now we have 100 shares. Let's say we put our order in here and we got our 100 shares here. So we're going to come in here and we're going to simulate this. We're going to come in here and we're going to say, all right, I'm going to come into my trading tab and I'm going to got 100 shares. So we're going to buy 100 shares. So, okay, so let's say that we just did that and we had our options order and it gave us $225 and we also got 100 shares. So the market closed below our red line and we got our 100 shares. So that's where we're sitting now. We got our red shares. We got 100 shares. Now what do we do with it? Well, you sell high, just like you did before. You take your limit order and you put your limit order up here and you sell them. You got 100 shares, right? And you're going to sell them for a profit of anything between the green line and the red line, which right there, that's $8,000. So if the market went up to the red line, you'd get $8,000, right? You're going to sell your 100 shares. We're not going to sell the shares with a red line with a limit order, though. We're going to do it with an option, a call option. Right? We can do the exact same thing. If we have 100 shares, we can come in here and we can say, I'm going to come in and I'm going to go to my options tab and I'm going to say, I'm going to sell a call right up here. Oh my gosh. I'm going to sell a call, which means that I'm going to sell 100 shares at that price. Well, I got 100 shares. So that means I can sell 100 shares. That's pretty cool, right? So within the next 52 days, if my 100 shares go up and touch the purple line, that's the carnival game. If the market goes up and touches the purple line above my red line, I'm going to sell my shares at the red line, which is going to give me a profit of, can't see it, of $8,900, almost $9,000. I'll take that $9,000 in the next 52 days. But what if it doesn't? What if it doesn't go up there? Well, you don't get to sell your shares for $9,000. You get the consolation price. You get the rubber frog of $1,035 instead. What? You're kidding me. You're kidding me. They're going to give me $1,000 just to promise that I'll sell my 100 shares for an $8,900 profit? Yeah. If you make $8,900 in the next 52 days, and then you're willing to sell your shares right there, they'll pay you $1,000 to do that. Seems too good to be true. I know. Why do you think I love this? Why do you think I love these markets? Why do you think I like doing this? Why do you think I sit here all day, every day? I'm so mesmerized. So, oh my gosh, I got to tell people about this. They're going to give you a rubber frog of $1,000 just to promise to sell your 100 shares at that price level after you've already made $8,900 on them. What's the downside? Well, the market could go higher, just like a limit order. It could go up here, and you wouldn't make any of this money. That's why people are like, "Oh, I don't want to do that. I might miss out on some profits up there." Get back in. Get back in. You can get back in. Just because you got out of the market doesn't mean you can't get back in. It's the silliest, dumbest thing I ever heard in my life. Well, I can't put a covered call on there to get out of the market because what if I actually have it filled and I lose my 100 shares? Okay, you just took $8,900 in profit and they gave you $1,000 to do it. And you're complaining that, oh, I don't want to do that because I might miss out on some future profit that I might make. Well, get back in. if you think it's going to keep going higher. Don't take the $1,000 then. That's the dumbest argument in the whole world. It's as if they can't get back in. Why can't you get back in? I don't know. Get back in. That's how covered calls, and that's how selling options instead of buying options. That's how selling options work. All right. So you sell an option and they're going to give you $1,000 just to put that order in there, even if it doesn't fill. And you get the $1,000 in addition to the $892, because if it fulfills the order, they're going to give you the $1,000 anyway. So you get $8,900 plus $1,000. You get the rubber frog and you get the big panda bear. That's the coolest strategy I can show you. I can't show you anything neater than that. All right. I just blew my whole wad showing you the neatest, coolest, best strategy in the whole world right there. If that was the only thing you did, well, it's the only thing I've been doing for years. This is the only thing you did. Now, this is very similar to what you do, what YieldMax does and Granite Shares. Granite Shares, they sell the puts. YieldMax, they sell the calls. Granite Shares sells the puts. So if you give your money to Granite Shares, TSYY, they're going to just sell puts, and those rubber frogs are what they're paying you with. All right. And then YieldMax, they just sell the calls up here, and that's how they make their money. And they give you the rubber frogs up here. That's how. So you're not actually doing it yourself. You're giving your money to YieldMax, and then they're doing it for you. And then they're going to just give you the rubber frog money. Now, YieldMax, one of the reasons I like YieldMax is because if the market's bullish, they get to participate in the upside as well, because their strategy is a little bit more sophisticated than Granite Shares. Granite Shares, all they do is give you the rubber frog money. That's all they make. They don't make any of the growth. They don't make any of this money right here, whereas YieldMax does. So you've got the upside potential with YieldMax. But the downside is that you've got downside potential with YieldMax too. If the market goes down, they lose money. All right. And they still get this rubber frog up here. They still get that money up there, but they lose money here. And so the rubber frog has to help cover the losses of this one. So if the market just keeps going down, well, YieldMax will keep losing money, and the rubber frog money can't cover the losses fast enough, right? Until it stops, and it stops. And then the rubber frog money could eventually catch up. That's how YieldMax and Granite Shares do it. This is what they do. This is exact strategy. This is a strategy I've been trading for. That's why I like YieldMax and Granite Shares, because they trade exactly the way I trade. Right? But you can do it yourself. It's not hard. It's not scary. It's about as least scary type of trading you can do, because even if you're wrong, you still get paid. And you don't lose any money. You don't lose any money if you're wrong. Well, you do on the shares. When you got the shares for the covered call side, you lose money if you're wrong. On the put side, you don't lose money if you're wrong. It just means you don't get your shares. But always do the put side first. You don't want to do covered calls against, unless you have 100 shares. If you have 100 shares, you can put your covered call up there, get your $1,000. And if the market doesn't go up there, you don't lose your shares. Now, one reason you might not want to lose your shares is because you have to pay taxes on that $8,900 in profit, right? You'd have to do some tax loss harvesting, like we've been talking about in the last classes. So you'd have to pay taxes on that. And some people are like, well, I don't want to pay taxes on my profits. Okay, so that means you don't want to sell your shares. So if you don't want to sell your shares and it does come up and goes above it, we can do what we call roll. So we just take that order, that $1,000, we add another one to it, and we roll it out a little farther, right? So we can just roll it out. We just spend a little money, spend a little bit of our $1,000 to roll it out and buy us more time, so that our order doesn't go above it, so that we don't actually have to sell our shares. But taking profit's not a bad thing. I have to pay taxes on it. Okay, we'll start a little business. Maybe you could do something like a YouTube channel. Call it your business and use all of those business expenses as tax deductions against your taxes. Maybe you could even, I don't know, maybe you could do something like sell a magazine so that you have tax deductions on a business. I know somebody who does that. In fact,
ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pitnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, you could do that. You could make money, pay taxes, have a business, sell a magazine, start a YouTube channel, and use all of your tax deductions for starting a small business off on your profits that you make trading. All right, guys, I just revealed the biggest, best, greatest business in the world. I don't know how it gets any better, easier than this. All right, that's how you make money. That's how you make money. I don't know if that's how you make money. That's how I make money. That's what I do. I'm not here to tell you what to do. I'm just telling you what I do. And that's what I do. And that's how I do what I do. That's how come I've never had a job. I don't know what I'd do if I actually had to work for a living. Oh my gosh, are you kidding me? If I had to actually work, I haven't worked in years. I don't know how. I just do this. So much better. All right, guys, that's all I got for you. I can let you go, and we will catch up with you. Let me see what any comments over here. Oh, got some good mornings in here. All right. I teach so good that nobody has any questions. That's what I say. If you don't ask questions, it means I'm such a good I'm such a good teacher. Nobody's asking any questions. All right. I guess you got it all figured out. If you do have questions, if you think of a question, you can always come and hook up with me. All right. You know that, right? I do this thing here. So just in case you guys want, you can ask me questions at any time. Scan that little code right there, and you can book a free bull session. We'll just, we'll bullshit there for a little bit, talk about your goals, your aspirations, things you want to do. Maybe you want to copy me and say, Lan, I want to do what you're doing. Okay, I'll show you how. And that's all we do here. I just show you how to do this stuff. And you can visit landturner.com and sign up and talk to me. And then that's always something you can do. And I'll help you one-on-one if you have questions, all right? And of course, you can buy my Pitt News Magazine, which is how I have a business. So I have a business, so I can write off all my expenses. So when I make money, I have tax deductions. And so that's why I sell Pitt News Magazine. That's why I have a little YouTube channel. So you can start your little business, do whatever you want. I don't know, whatever you can do to have some business deductions. All right, that's the game. That's the game we play. And if you have any questions, let me know. My email address, lhturner@landturner.com. I guess that works. Landturner at landturner.com works, or lhturner@tradementors.com. Either one. And I'll help you do this. That's why I'm here. I teach at the university to help people do it down there. I teach you this stuff. It's fun. Do it this way. Make money. Have a good life. See ya. Don't work. Bye.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.